So let's say you valued a business. You've added cash, you've added cross holdings, you've taken any other assets that are out there into account, and you've subtracted out debt. You have a value of equity for an ongoing business. In this session, I want to talk about 3 additional components that might show up in your valuation. Not always, but sometimes. The first is synergy. Usually you hear this word in the context of acquisitions, where 2 companies come together and they're able to do something that they could not have done as individual companies. Does that have value? It could. And we'll talk about how best to value that item. Second is control. Again, it often shows up in the context of acquisitions. Many companies pay a control premium. They'll add 20-25% of the value of a business to reflect the value of control. But what's control? And why is it worth what it is? Hopefully you will have an answer by the end of this particular session. The last component that I want to talk about is complexity. Some companies are more difficult to value than others. And while you value them, you have to wonder whether the value should be discounted for that complexity. That's an open question. And I hope to at least lay the framework for answering that question over the course of the next few minutes. So let's see where we are. We know how to value a business now. We've got the expected cash flows, discount rates, growth rates, and terminal value. We've talked about the loose ends of how to get from the value of the business to value of equity. This session, I want to look at a specific scenario in valuation. Let's suppose you're valuing a company for an acquisition. What are some of the issues you might have to deal with? And in particular, there are 3 issues I want to address in this session. The first is I want to talk about synergy. It's a word that's often bandied about in acquisitions, and people pay huge amounts for synergy. But what is it? How much is it worth? How do you come up with the value? The second is control. In many acquisitions, you'll hear talk of a control premium, where an acquirer pays 15, 20, 25% above the market price as a control premium. What's a control premium? What's control worth? How do you value it? How do you decide whether to pay 10, 15, 30, or 50% for it? And the third, which might not always be specific to acquisitions, is what if you're acquiring or investing in a complex company, a difficult company to value? How do you bring that into your valuation? So let's start with the first issue, synergy. As I said, in many acquisitions, synergy is a word that gets thrown around often after the fact. What do I mean by after the fact? You'll see a banker value a company at $100 million. And the only way to acquire the company is to pay $150 million. So what do? They call the extra $50 million a synergy premium, in which case synergy becomes a plug variable, something you use to explain away the higher price you're going to pay. Now, when I hear the word synergy, I can attach a value to it, but I need to know what form the synergy will take. And broadly speaking, synergy can take one of 2 forms. It can be operating synergy or financial synergy. Let me take operating synergy first. Operating synergy itself can take two sub-forms. One is cost controls, economies of scale. By combining 2 companies, you might be able to cut costs. Why? Because you might have overlap. Those cut costs lead to higher margins, higher operating income, higher cash flows, higher value. That's the easiest synergy to value, is economies of scale. The other form of operating synergy is a little messier. These are growth synergies, and they could take multiple forms. They can take the form of higher returns you make on combined projects. So basically, synergy shows up when you have 2 companies coming together and they can do something they could not have done individually. The combined company earns higher returns on all of its investments. It could find more investments, or it can maybe build up barriers to entry to keep the competition out, which shows up as higher excess returns for a longer period. If you see where I'm going, basically I'm looking for an input in my valuation model that I can nudge to reflect the value of synergy. It's going to show up as a higher growth or higher cash flows. They both show up as higher value. Financial synergy can take one of 3 forms. It can take the form of tax benefits. The tax code might have issues in it or code in it that allows you to take advantage of being a combined firm. Here are a couple of examples. By combining 2 firms, you might actually be able to increase your depreciation charges each year. Why is that good? While that lowers your earnings, it increases your cash flows. It could also be that a portion of goodwill, that extra amount, the difference between the market value and the book value that you're allowed to book, show on your balance sheet, you might be able to write off and claim a tax deduction for it. Very unusual in the US and Europe, but in some emerging markets, you might be able to get away with that. Those are tax benefits. They increase your cash flows, increase your value. It could also show up in the form of higher debt capacity. 2 companies that by themselves could not borrow much money when they come together, might be able to borrow more. Why? Because they're larger, they're more stable. When you can borrow more, your debt ratio goes up, your cost of capital goes down because you get a tax benefit, increases your value. And there's a third potential financial benefit that's a bit controversial. Two companies come together, especially if they're in different businesses, the combined company is more diversified, right? If these two companies had been public, that's no big deal. The investors could have gotten there by themselves without paying the premium. But if the two businesses are private businesses, there is the potential for saving because there are some risks that you now are able to diversify away that hitherto were not diversifiable. So in the case of two private businesses, diversification might actually be your synergy benefit. My job when people talk about synergy is to convert talk into numbers. And here's the process I go through to value synergy. First step in the process, I value the target company standing alone, and I value the acquiring company standing alone. You cannot value synergy by just valuing the target company. You have to bring in the acquiring company into the mix. Second step in the process is I'm going to add those two values together, because if there were no synergy, that's what the value of the combined company would be. Values are additive. Third step in the process is I'm going to value the combined company with all the benefits thrown in, the higher growth, the lower cost of capital, the higher debt ratio. Presumably, the value you get in step 3 of the combined company with the synergies is greater than the value that you got in step 2 by just adding up the values of the standalone companies. That difference is the value of synergy. So let me take a very simple example to illustrate this process. This was an acquisition that happened about a decade ago. The largest consumer product company in the world at that time, Procter & Gamble, bought the fifth or sixth largest consumer product company at that time, Gillette. And much of the talk around the time of the merger was about synergy. So I decided to do a best case valuation of synergy. In a minute, you're going to see why it's best case. First, I valued the two companies standing alone. I came up with a value of about $221 billion for Procter & Gamble, about $59 billion for Gillette. You add those two numbers up, you get a value of about $280 billion. If there had been no synergy, that's what the value of the combined company would have been. Then I did a best case valuation. Best case because I took everything managers told me they would do and assumed it would happen instantaneously. So they talked about cutting costs by $250 million. I assumed it would happen right away. They talked about increasing growth. I assumed it would happen tomorrow. I revalued the company with the lower costs and the higher growth rate. I got a value $17 billion higher for the combined company. That's my value of synergy. So when people tell you that finance people think that synergy is worth nothing, that's not true. Synergy is value, but here's the problem. Procter & Gamble did buy Gillette, but it paid $25 billion as a premium. If your best case valuation of synergy is $17 billion and you pay $25 billion, how are you going to win at the acquisition game? And the reason it's a best case valuation is in most mergers, it takes time for you to collect those benefits. So if you have to wait 3, 4, 5 years for the $17 billion benefit, well, guess what? It's worth only about 13 or 14 billion. So if you're going to do an acquisition and justify it based on synergy, you have to value synergy and bring it into the process and make sure you're not overpaying for it. So that's the first step in this process. Think about synergy, think about how much it's worth. Now let's talk about control. To value control, I'm going to argue that you have to do two valuations of your company. The first is a status quo valuation with the existing management running the company. And the second is a valuation of the company with you running the company. And here's why. The value of control comes from the fact that you think you can run a company better than the existing management. Put differently, if you have a company that's already perfectly managed and perfectly run, the value of control is 0. If you have a company that's badly managed and badly run, the value of control can be immense. It's the difference between two values. The value of the company run by you with better investment policy, better financing policy, better dividend policy, versus the value of the company run by the existing management. Now, of course, for you to be able to pull this off, you have to estimate what the likelihood is that you can replace the management of the company. That could range from 0, if the management is entrenched and they own all the voting shares, to 100% if the company is in play in an acquisition. But to value control, you have to do two valuations and assess the likelihood that you can change the way the company is run. So let me take an example to illustrate this process. Don't get too caught up in the numbers on this page. There are too many numbers. But this is a valuation I did of a Croatian tobacco company called Adris Grupa. So in the first scenario, I value the company with the existing management in place. They're not bad. They reinvest a lot. But the return on capital they make on that reinvestment is 9.5%. By itself, that's not a bad number, but that's lower than their cost of capital. They're also very, very heavily equity funded. So this management does not like to borrow money, and they're actually investing in projects that earn less than the cost of capital. I get a value for the company. That's a status quo value. I can revalue the company with somebody else running the company. Doesn't have to be me. Using a slightly higher debt ratio. I'm being realistic. I'm not asking them to borrow 90%. I'm actually just pushing them to a 10% debt ratio and actually reinvesting only in projects that earn their cost of capital. Again, I'm not asking for miracles. I'm just saying just break even. With those two changes, I get a new value for the company. This is my optimal value. The difference between those two values is my value of control. So if you talk about value of control, think about doing this for the company where the talk is around. If you get about the same value, the status quo and the optimal, there is no value of control. If you get very different values, there is a basis to the value of control. There's no easy way around this process. So now we have a status quo value and an optimal value for Address Group. Here's an interesting twist. It's actually a way you can think about why voting shares often trade at premiums over non-voting shares, because Address Group had both of those. Here's the way I think about non-voting shares. If you get a non-voting share, you're stuck with the status quo, right? Not much you can do about changing management. So to value a non-voting share, here's all I do. I take the status quo value and I divide it by the total number of shares outstanding, voting as well as non-voting, and assume that that is the value I'd pay for the non-voting share. Then I take the difference between the two values that I got, the optimal value and the status quo value, and assume that only voting shareholders get a share of that. It'll give you a higher value for the voting share. In this case, for Address Grouper, you get a premium for the voting share because there's an expected value of control. That premium is going to be larger, therefore, in companies that are badly run. So if you have voting shares in a badly run company, it'll trade at a bigger premium over non-voting shares than in a company where the company is well run. That's an interesting perspective to have as you think about social media companies, where increasingly you see two classes of shares in almost every one of these companies. This brings me to the last issue that I want to talk about in this session, which is complexity. I've wrestled with this for a decade, so let me lay out what I'm talking about. Let's suppose you have two companies that look exactly the same in terms of numbers. Same profit, same return on capital, same cost of capital, same growth rate, but here's where they're different. The first company is a simple company. Simple in what sense? It's in a single business, it has a very simple holding structure, and its accounting is transparent. The second company is a complex company. It's in multiple businesses, has a complex holding structure, and its accounting is opaque. I would argue that most investors would value the simple company more highly than the complex company, because with the complex company, you're worried about what you don't know, and you know that what you don't know is more likely to contain bad news than good news. But if you want to bring complexity into valuation, you first have to measure it, right? So I'm going to give you two alternate measures of complexity. Here's a very simplistic one. Just count the number of pages in the 10K, the 10Q, or the annual report. I know it's simplistic, but I've found that when companies take hundreds of pages to tell you what happened during a year, that they're probably very complex companies that are difficult to value. Now, I know it's simplistic, so you can expand your definition of complexity, and I've tried on this page, and I got a little carried away, by looking at multiple questions you can ask to measure complexity. I have a complexity score. Now, you can take a look at these questions and see if they make sense to you. But what I'm trying to come up with is a score that measures how complex a company is. How am I going to use it? If I'm doing a discounted cash flow valuation, I have to bring in that complexity measure somewhere into my numbers. Either into my cash flows, by lowering my cash flows, into the discount rate by increasing my discount rate, into my growth rate by lowering my growth rate, or into the value of the growth by lowering the excess returns or how long this company can grow. So more complex companies for the same cash flows will have a lower value. If you're doing a relative valuation using a multiple, you might use a lower multiple of earnings or book value for companies that are more complex. In fact, as a final piece of this session, I have a regression here where I've taken price to book ratios of large market cap companies in the US. I've regressed them against the usual fundamentals, growth and return on equity, but I've thrown in a variable that you usually don't see, number of pages in the 10K. You know how you'd read that coefficient? Every 100 additional pages in your 10K knocks down your price to book ratio by about 0.3. Think about it. You're a complex company. You have hundreds and hundreds of pages in your 10K. you'll trade at a lower price to book ratio than an otherwise simpler company that looks just like you in terms of the financials. There is a price to be paid for complexity, something that companies need to factor in as they go multinational and multi-business. So in summary, if you're called in to do an acquisition, don't give up on the buzzwords. If there's synergy, value it. If there's control, put a number on it. If there's complexity, deal with it.